Co-ownership financing. So we're going to talk about what it is. I'm going to give you some example scenarios. I'm going to talk about where it's available, and I'm going to talk about steps to pre-approval and to make sure as realtors, you need to be registered for this particular program. I'm going to show you how to do that as well. What is co-ownership financing? So co-ownership financing or shared equity financing. I like shared equity because co-ownership, people don't really understand what that means. Shared equity is basically probably the better term. Shared equity basically closes the gap to give you a 20% down payment. Okay. It's for owner occupied homes only. So all you people who think, oh, this would be great for my investors. No, not so much. Has to be a principal residence. Let's say I want to buy a home and I have to have a minimum of 5% down. They will give me the rest to make a 20% down payment. So what does this mean? The maximum amount that the co-ownership company, which is a company called Arborough, will give you is $250,000. So that means under this particular program, I can buy a $2.5 million program with 10% down, because I would need, you need a 20% down payment for any property that's over $1 million. So the maximum they're going to give is 250. So if I had 250, I could buy a $2.5 million property under this particular program. If I only had 5% down, I could buy up to $1.7 million property under this particular program. Okay. And basically, I'm going to explain how it works when you're purchasing a property. Okay. How the equity split works. Okay. And I'm going to talk about what happens when you sell that particular property. Let's say I want to buy a property for $1 million, right? And I have $50,000 is all I have saved, but I really like this $1 million property. How do I come up with the other money? Well, first of all, I'm going to look for relatives. I'm going to look for any other people that can maybe gift me some money so I can, but not everybody has rich relatives that'll do that. And some people, some of the relatives are overseas, or they're first generations in Canada and things like that too. So how do I get equity for the down payment? Well, with this particular program, they'll give you whatever you need to make the 20% down payment. So if I have 5% down, okay, they will give, and let's say on $1 million property, that's $50,000. They will give the rest, the $150,000, to make my 20% down payment. So then I'll have an $800,000 mortgage, 20% down payment is $1 million property. Okay. Now, but depending on what my down payment is, will translate to an equity split. Okay. So if I put 50,000 of the 200,000, that's 25%. So my equity share in this home is 25% as the homeowner. Okay. The co-ownership company, their equity share in the increase or decrease of this property is 75%. Okay. Let me go another scenario. Let's say I had more money down, just so I can show you the difference here. Let's say I had 8%, which is 80,000. All right. So I put 80,000. They put the balance of 120,000. That would make a $200,000 down payment. But now my equity share is 40% because 80,000 of 200 is 40%. Okay. So that's how the equity share is split based on whatever that down payment is. So let's look at what this means for a couple of families that we worked on. Okay. So we had family number one. They were newer to Canada, right? So they wanted to buy their first condo, and I think their combined salary was like $85,000. All right. They had $40,000 as a down payment that was saved. So they want to buy a condo in Toronto. The maximum that they could afford based on the insured, because it was CMHC insured or Genworth or Sagan, I guess it is now, was $400,000. Okay, so that was the maximum. Okay, under this particular, and they couldn't find that condo that they like nothing for $400,000, but they under this particular program they're able to buy for about $570,000. So it increased their purchasing power. So how does it increase your purchasing power? Basically, now I know I have 20% down. So what we do now is we get rid of the insurance. There's no more CMHC. They just saved all that money. We now increase the mortgage to a 30-year amortization to qualify them for their maximum mortgage. Okay. And then we add 20% down payment on top of that, which increases their purchasing power. Okay. That's the dramatic difference that it makes when you're using this. The other really cool thing when I did this for these guys, their payment difference was less than $248 per month between $570,000 and $400,000, because again, got rid of those fees, increased it to 30-year amortization, and therefore the payment difference was very minimal. Okay. Family number two, they have really good income. doing really, really well, but they had $100,000 saved. So family number two is interesting because they were renting for about $3,600 per month. They had 3 kids and they wanted to buy they could not find, so they wanted to live in the GTA, but they couldn't find a 4-bedroom home that was under $1 million. Okay. And remember what I talked about, if you have any property that's over $1 million, you need a 20% down payment. Maximum we could get them here is 900,000 because it had to stay high ratio, right? Because they didn't have the 20%. Under this particular program, they ended up finding their 4-bedroom home at 1,150,000. Okay, so that's how it makes a big difference in terms of how much more you can qualify by adding that 20%. When we go through here, the other thing we talked about that is interesting with this particular program is closing costs. Okay, so I'm going to talk about this first, and then I'm going to talk about what happens when we sell the property. Okay, one, we eliminated the insurance. Okay, so there's no more insurance. The land transfer tax is also split proportionate to the payout. So for example, the homeowner would always get the 100% of the first-time home buyer's incentive if you are a first-time home buyer. And by the way, you don't have to be a first-time home buyer to use this. It could be for repeat buyers. That's another question I know is going to be asked. And for example, on an $800,000 purchase, if I put the $50,000 down, that gives me a 31% equity share. Okay. The total land transfer tax on this amount is $12,475, assuming it's not in Toronto. Okay. Arborough, the ownership company, would pay $85.76, their portion. The client's portion is $38.98 minus their first-time home buyer. They actually get a credit of $525, so they can actually end up purchasing and not owning any more land transfer tax, actually getting credit, not having to pay that land transfer tax. So what happens when I sell the property? Okay, this is really important, right? Because now it's like, okay, kind of get it, gave you 20%. What's the catch? What's going to happen when I sell? Okay, so understand, so there's an equity share, so you're able to buy this property because they're actually contributing and give you that down payment to allow you to get into the property, which translates to the equity share. All right, so let's use this scenario. So let's say that $1 million home that we bought, that I put say $80,000 down in. Okay, now I sold it at 1.5 million, let's say 5 years from now. Okay, so 1.5 million. Now I started out with an $800,000 mortgage, but let's say over the 5 years I paid $100,000 off on the mortgage. Who gets credit for that? The homeowner. It's their home. I get full credit for that. So now instead of being paying rent every month, now I've been actually contributing towards equity for myself for all those mortgage payments. Now I've got $100,000 of equity because I paid down the mortgage. Okay. Now let's look at the net proceeds. Okay. So of that net proceeds, okay, 280,000, okay, would be mine for my 40%. Okay. And Arborough would be at 60%. They would get 420,000. So let me go to this chart to show you the grand total of what I'd be walking away with as a homeowner. Okay. So the increase, 280,000. Okay. My mortgage principal, 100,000. So now I just walked away with $380,000 of equity out of this particular property. Okay. Arborough, the ownership company, would get say 420,000 because it's just of the increase or decrease. Now, what would happen if it didn't increase? What if it was the same amount? Well, I would get my $80,000 because I still have that equity in it. I would still get my $100,000 as the homeowner. Okay, so I'd walk away with 180,000, and Arborough would get their 120,000, their original amount. All right, Lauren, what would happen if the market tank went down to 800,000? What would happen? Okay, so we both just lost all our equity because because everything just went to the tank. As the homeowner, I still get all my principal payments because it's my home. I made those principal payments, so I would still walk away with 100,000. Arborough would walk away with nothing. Okay, so they share in the risk of it going up and down. The equity portion is only on the increase and decrease. They're not ownership on the house or anything else. That's how it translates. How long can I be in this program? So you can be in this program for up to 10 years. Okay. What happens after 10 years and I still want to live in this particular home? Well, then you do an appraisal, refinance, pay out the equity portion. That's as simple as it is. Okay. Understand that most people, especially first-time home buyers, will sell their home within 4 to 6 years. There's a high percentage of them. I think it's over 70%, somewhere close to 67%, or I forget the exact amount. but a large amount of first-time home buyers will sell a home between 4 to 6 years. This is ideal to get into a home, build equity in that home, and use the leverage, that equity, to actually get out and buy something else. If I took let's say I had $50,000 and I put it into a bank account that gave me 10% per year, okay? After 1 year, I would have, what, 5,000? I don't think the math is that hard, right? But what if I took my $50,000, okay, and then put it into $1 million property that was increasing by 10%? So now I've just changed I've doubled my money in 1 year because I've used the entire amount of that property to increase and leverage to increase my equity position. Okay, so that's kind of where the magic, if it does work. So up to 10 years, the co-ownership or the shared equity entity is not on title, okay? They are not going to show up as a lien. They're not going to show up as a mortgage. It's just going to be the owners on title. There is a beneficiary agreement in the background showing that they have a beneficiary interest in the property that would prevent them from selling it without their permission and things like that, or refinancing, but they're not on title. So no matter where I do my financing, okay, or there's only certain lenders that actually accept this right now, we can move it from one lender to the other a year after, because now there's no more down payment element. I could go anywhere really I wanted to, okay, as long as the lender's okay with that. I can sell at any time. Let's say the market goes down, I need to sell, I lost my job. Is there any restrictions? No restrictions whatsoever. There's no expectations in terms of, as long as you're selling it at fair market value, you're not selling it to Uncle Nunzio for $20 and trying to, beat the system. It's got to be fair market value sale, but you can sell it anytime. There's no restrictions whatsoever. So there's no liens, no loan payments. And like I said, you can move from one institution to another institution.